Demand for industrial metals like copper, aluminum, lithium, and others have been dramatically lifted by the global shift towards renewable energy and just the ever-increasing demand for more energy across the board. Among this group of industrial metals is uranium, which has seen its price and demand soar. Today, we get to enjoy a head-to-head ETF battle between two uranium funds from DeLegge and Sprott Asset Management. Stick around. You're watching Season 4 of ETF Battles. I'm Ron DeLegge. This is an original series program that I created to help you make better investment decisions. And if you're enjoying the show, well, then tell us in the comment section below or by subscribing to our channel. Also, besides this show, I also produce other originals, including Portfolio Makeover and First Look ETF. So just hit the playlist section of ETF Guide TV to watch those programs. Now, besides YouTube, ETF Guide TV can also be seen on Amazon Fire TV along with Roku. So check out those platforms. Don't miss it. Also, be sure to check out the video description section. We've got links to our program sponsor, Direction, along with links to our program judges. Be sure, again, to check out that area. We've got lots of excellent resources for you. Get in touch. The need for more global energy has pushed nations around the world to build nuclear reactors. Now, some are opting to build smaller, more cost-effective solutions known as modular reactors. So this, along with the ever-increasing need for renewable energy, has lifted demand for many industrial metals, among those uranium. And it's caused, in the case of uranium, a massive supply imbalance and soaring prices. Bull market, anyone? Today's ETF battle is between a pair of uranium ETFs. We've got URA from DeLegge going up against URNM from Sprott Asset Management. Helping us to sort through the mayhem, we've got our program judges, Cinthia Murphy with the ETF Think Tank and Mike Akins with ETF Action. Welcome back. Great to see both of you.
It's great to be here, Ron. Good to see you, Cinthia.
Hey, guys. Happy to be here.
So we're going to begin here with our four battle categories: cost, exposure, strategy, performance. And then we've got our mystery category where you, our judges, can pick a single factor or multiple factors that you feel are important to today's contest. You can also nominate wildcard ETFs if you feel there's better choices elsewhere or opt for split decisions. I've got the scorekeeping duties. At the end of the show, we'll declare an overall winner. Now, keep in mind, none of the battle outcomes are ever known in advance by myself or our judges, or are they predetermined? So let's start with Mike. The first category is cost. Please get us started.
All right, so we've got a very explosive matchup here today in the nuclear category. The expense ratio is going to pretty easy win here for URA at 0.69 versus 0.83. Also has a little bit more liquidity, but they're both very liquid. They both have over $1 billion in AUM. They trade quite regularly, and their spreads are very reflective. In fact, I would say that you can trade these ETFs cheaper than you can trade the underlying names by far and away. So both exhibiting that benefit of the ETF wrapper, but I'm going to save my time and tell you that URA is 14 basis points cheaper. It wins, but it is not a big factor in this battle today.
That's a strong start. Thank you, Mike. Cinthia, you're up next. How do you see it when it comes to cost?
Agree 100%. URA wins this category.
All right. Well, that takes us next to exposure strategy. And this is where our judges can explain what's happening underneath the hood. So, Cinthia, please give us your analysis.
So these two funds are different in what I find to be an interesting way. I like to think of the Sprott product, URNM, as a more pure play exposure to uranium itself. It invests in companies that are at least 50% of their assets are tied to the actual mining, exploration, production of uranium. It also invests in companies that actually hold physical uranium. And it's an 82-18% split. So 82% is the producer, the miners, 18% is actual, tied to what you would call a physical allocation. So it's a really interesting mix of all in on uranium itself. The Global X product, URA, is a little bit more diversified. There's parts in there that are, technology support to the industry, parts, components of the nuclear energy story. So it's a little less pure play in my mind if you're really looking for exposure to uranium. It also goes out of its way to have an ESG factor, if you will. It looks to, avoid controversial weapons industries, or it gets a little bit sideline, I think, with these other storylines. So I think from an exposure perspective, if you're looking for exposure to uranium, I like the URNM, the Sprott product in this category better.
Mike, you're up next. How do you see it when it comes to exposure strategy between these two uranium-focused ETFs?
Well, I wish I'd have gone first because Cinthia hit the nail on the head with her analysis. It truly is. I think of it, you think about gold miners, been around forever, GDX, something like that. Those are really going to be highly correlated to the spot price of gold, sometimes levered, sometimes not. But in general, if you overlay it on long term, you're going to see gold prices go up, the gold miners go up, probably at a higher multiple, just a little more leverage to their balance sheet. But there's going to be a very high correlation to that spot price in the names. URNM is a spot play. URA is the Global X product, a little more diversified. It's also going to have exposure to those names. In fact, there's about a 43% overlap between these two portfolios. But as Cinthia pointed out, it's a little bit more diversified. And I think the way to think about it for your viewers is, are you making a call that uranium isn't going to be in higher demand and I want to get exposure to that through an equity-like product, maybe a little bit of leverage? Or are you saying broadly as a category, uranium is going to make a bigger play back into the world of supplying energy? And to that extent, then Global X's product, URA, deserves a little bit more thought, because you're going to get some of these companies that are going to build out the technology to deliver that uranium, right? We've been in a world where nuclear power plants have been coming offline, not online. If you think that's going to reverse and it's going to go the other way, then I think URA has a play. So they're both going to be pretty highly correlated. They have a high overlap, but spot play is URNM. A broader play on the category, what's going on with how you're going to use that uranium, I'd say URA, which is the Global X product. Category winner, boy, it's a tough one for me because they're just different on what you're trying to achieve. I'd say right now I kind of like the URNM approach. I like that spot price play. I think it's a good way to play it, and it's played out this year in performance and risk, which we'll get to in a second. But it's a very unique once you get past that core element of the miners.
Well, I'm enjoying our analysis from our judges up until this point. We still got more to go. So that takes us to the next category, which is performance. And this is where everyone's bunny rabbit ears go up, right? What have these ETFs done? And you're about to be blown away. So, Mike, you're still up. Give us the performance update. What have these two ETFs been doing? Yeah,
so, year to date, as we alluded to earlier, spot price uranium has been doing very well. So as a result, URNM is got the best performance on the shorter time period. If I'm looking year to date, URNM is up 40%, URA is up 28%. So both doing really, really well. URNM only has a 3-year track record. It is outperforming URA over that time period, but that can all be attributed to the outperformance this year. So it's hard to say, 1 year, 3 years, it's both going to URNM, but a large part of that is because it's got a short time period. URA has a much larger history. It goes back over 10 years. And it's, as you'd expect, it's been up and down depending on the mood of that category. It got off to a really bad start, but then over the last 5 years, it's really been doing quite well with a 20% annualized return. But just from a pure performance play, what we have to judge, URNM is the winner. It's provide a little bit more pure play to that spot price of uranium, which has been doing really well.
Thank you, Mike. Cinthia, you're up next. How do you see it when it comes to performance between these two uranium-focused funds?
Yeah, I agree. At face value, looking at the numbers, URNM has, that thing this year is on fire, is up dramatically. It's beaten URA, I think by a sizable margin. It's in that outperforms in a 1, 2, 3 year period. I mean, all of Mike's points are true, accurate, and valid. So if you're looking at just performance, the numbers are there. It's URNM is the winner.
You can argue with me, but you can't argue with the math. That takes us next to the mystery battle category. And this is where our judges get to choose a single factor or maybe multiple factors to support their analysis and make their arguments like a court of law. So Cinthia, of course, without the judges and lawyers. Cinthia, you're up. What is your mystery battle category, and which of these two ETFs wins it?
So I was thinking in terms of kind of opportunity, if you will, or near-term opportunity. Nuclear energy has been, to Mike's point earlier, really frowned upon for a long time, but that has changed. I mean, there's a lot of stories out there. There's a Gallup study that shows that public sentiment towards nuclear energy is at a 10-year high. There are reports of hedge funds now piling into uranium. The opportunity is there. I mean, energy transition is a story that's just starting, and uranium is a key player in that story. There is no energy transition without uranium. So the momentum is there for this to be a really hot and growing topic and an investment opportunity. So from that perspective, you could say that you could invest in a broader clean energy type of fund or, energy transition fund where uranium is a component of that. But for now, the real punch is in the uranium itself. Just look at the performance of URNM versus URA. It is the uranium itself. So I think the opportunity right now is in the actual uranium, not in the value chain of the industry as much. So I would just go for the most pure play exposure you can get to this space. It's also like a good diversifier. It sits outside of most other buckets in your portfolio. So I would go with URNM right now for that moment.
Mike, you're up next. What is your mystery battle category, and which of these two ETFs wins it?
Yeah, so I think I have two things I want to talk about in the mystery. One, I think Cinthia already touched on, which is more of a macro observation. And whether or not you invest in either one of these ETFs comes down to a little bit of your macro assumptions relative to how the governments and public overall is going to embrace nuclear as a means for a emissions-free type of world. Is it part of the renewable energy or is it not? Is it part of clean energy or is it not? Is it going to receive the same support as the other categories, or is it just going to continue to run into the same roadblocks it has over the last couple of decades relative to potential negative environmental aspects to the category? So you have to have a call on that before you even think about playing in this space, in my opinion. The other piece is this is a great opportunity to talk about what thematic ETFs are all about, what high conviction ETFs are all about. These portfolios are made up of both of them about 80+%, 85% international stocks. A lot of them are small cap names. They're not crazy liquid. And these ETFs present an extremely efficient way to allocate to the space. So it is going to be a much better experience for the average investor if they believe in this as an allocation of their portfolio. And my last point there, if they do want it as an allocation of a portfolio, how much exposure do you think you get to this category if you own the S&P 500? Zero. Not a single name in either one of these portfolios is inside of the S&P 500. So it truly is going to be a differentiator. You don't have to add a lot to make a change to your portfolio. It's a volatile category. So if you believe in the space, I like both strategies. They both do it. It does come down to that decision. I think they're both really good products, and I think they're going to have a high correlation. URA if you want the spot. URNM if you want the spot price. That's your play. URA if you believe a little bit more in the construction and engineering companies and the firms that actually build these nuclear sites. It's going to provide a little bit more of a diversified play into nuclear as a whole, not just the spot price of uranium. So I don't have a clear category winner, but I think the biggest takeaway is they both provide a excellent tool, allocation tool to the space, but it's up to the user of the tool whether or not it should be in their portfolio.
Great points, Mike. Thank you very much. And a huge endorsement there for thematic ETFs, as you mentioned, for making this even available to everyday investors. So that takes us now to the part of the show where our judges can give us their overall battle winner. And Mike, you're up. Give it to us. It's
hard for me. I think there's 4 nuclear ETFs, if you will, that we categorize as in uranium, nuclear, in the thematic space. These are the 2 largest. These are the 2 most liquid. So great pick by whoever as far as the battle setup. I truly do believe it comes down to what you're trying to play. If you're playing the volatility and the spot price of uranium, then I go with URNM. If you are playing the long-term build-out of the nuclear space, I actually think you're going to have a better ride playing URA. And to that extent, given that I don't think there's a lot of people out there that can make a short-term call on the spot price of uranium, I'm going to give it to URA as just a broader play into nuclear. But honestly, they're both great products, and it depends on your use case.
You are so difficult. I swear to goodness. You give it to URNM the whole show, and then you throw me a left curve.
It's the old 80-20 rule.
URA. You are so unpredictable. Actually, you're just like the price of uranium is what you are.
Yeah, exactly.
Very fitting. I'm just kidding with you, Mike. Thank you very much. Cinthia, you're up next. What is your overall battle winner for this uranium showdown?
So I guess I won't dare agree with Mike at this point. I'll just pick somebody. But I think to Mike's broader point, it's the beauty and the challenge of the ETF world. Access can be sliced and diced in so many ways. There's really no one-size-fits-all solution to different portfolio needs. So you really have to know what it is that you're trying to achieve. Now, as far as uranium goes, for the sake of argument, I like URNM. It is, if the purpose is, I want to invest in the uranium story, this is as pure play as you're going to get. It's a big fund. It's liquid. It's, affordable relative to everything else too. You're investing in the miner, the producers, the explorers, and the companies actually holding uranium. So for pure play's sake, I like URNM a little bit better here.
All right. Well, our judges have spoken. And how will this go down? Well, according to my battle scorecard, this is going to be a split decision between URNM and URA. And like I said, at the outset, I was shocked that Mike chose URA as his final battle winner. But he laid out his arguments and he said, hey, listen, if you're going to use URA more to capitalize on that longer term theme of the engineering companies and the technology companies that are building out that sort of nuclear energy and renewable energy with uranium, well, then he likes that as a longer term play. But he also did vote multiple times for URNM, citing that if you're trying to play uranium as a spot play, that was his preferred choice. Cinthia agreeing with him. And so she made her point that, listen, that's a better choice for her. It's affordable. It's liquid. It's also both of these funds are also very big too, with well over $1 billion in assets. So great job to both of our judges for breaking it down and making sense of this uranium ETF battle. We couldn't have done it without you. Thanks again, Mike and Cinthia. We appreciate your analysis.
Great being here.
Yeah, thanks for having me and for keeping it interesting.
Well, thanks again to Mike and Cinthia for their excellent and timely analysis. Keep up the good work. Be sure to visit the description section below. We've got links to both of our program judges. Get in touch. We've also got a link to our program sponsor, Direction. So be sure to check that out. Again, go to direction.com. Which ETF battle would you like to see in our next episode? Send me your ETF tickers in the comment section below or on our X feed at ETF Guide. I'm Ron DeLegge. Thanks for watching ETF Battles. We'll see you next time.